What's happening, investors? It is the video log takes 30,000 to a million. I'm gonna go through the account, review all the positions, and review all the positions and show you the account in detail, including the account tab, which includes the margin level and all that. Compare a little bit of performance briefly, and then I'm going to talk about why you wanna structure your options plays around the strike price. And spoiler alert, it's because the premium is the fattest around the strike price. And I'll show you some examples when I'm full screen like this again. For some reason, not getting enough light, it seems like. I don't know why. Anyway, going into the account, I'm sitting at a miserable $191,000. Like 20K off the top, maybe. I think it peaked out around 2014. So, $23,000 lower now. So that's not too fun, but it's not the end of the world either. So, 1 month chart is minus 6.2%. 1 week chart is minus 4.49. And today it was a negative 2%. So I've been dropping harder than the market. One of the reasons for that is because Apple has been dropping hard. And I guess all my positions are a little bit levered, right? So I'm going to go through the positions really quickly here, especially the option ones. You can pause the screen at any moment to try to figure out the exact position if you're interested in that. And then I'll move to the equities. So scrolling down, I have a lot of options sold expiring on the 16th. So that's going to be a big date for me. So far I'm doing okay. I'm hanging in there. The options are definitely going against me because of the drop in the market, but I haven't reached the level of where I'm gonna have to go into debt in order to buy some of this collateral that I have signed up for. So these are the equities here. Apple is down 1.46%. Realty Income, Main Street, Paramount, Smith & Wesson, all down. Here's the account tab. I'm going into the investing tab here. The margin's now increased. It's 10.91 because of the total amount of the account has decreased. So I'm at 10.91 times 2. That is 21.82% levered up. Here are the positions ranked by total return and the position ranked by size. Now, next thing is the performance. I already briefly went through the 1 week, 1 month, 3 months. I'm up 8%. 1 year I'm up 5.83. All time, obviously. When I show this chart, I always have to make sure I show that I started investing somewhere here in August 28, 2018. So that's why it looks so flat beforehand. Here's that little in larger multi-year perspective. This is what this drop has been here so far. It's not that big percentage-wise. I mean, it seems huge. It's 23,000, but let's say compared to the one in February and early March, it's not that big relative to that, right? And especially to the March 2020. Oh my goodness. All right. Now, let's talk about options, right? So the main thing about the options that I want to talk about today is that you want to use the fact that the premium is the fattest around the strike price. So a really easy way to illustrate this is, let's just go into Apple and we're gonna deal with some calls here. We're gonna trade options. Buy call or sell call doesn't matter because the prices are not gonna change. It's gonna be the same. So look at this, right? The 155 call, this September 9th. The 155 strike point call is $305. So you want to take this number and multiply it by 100, by the way, because one contract consists of 100 shares. So that's why 305. Now, 155 is just 65 cents lower than the current strike price. So the total premium really is $240. the premium itself. $240 to buy or sell a call at the 155 strike price. Now that's going to be the fattest out of all of them. The further you go away from the strike price, the less the premium becomes. Now this is really easily demonstrated if you just scroll up, because you can see the numbers on the right here. Let me see if you can see the numbers. Yep. You can see the numbers on the right, they keep decreasing pretty rapidly. In some cases, they'll decrease even more rapidly for some other stocks that are perhaps even less volatile. It's harder to calculate on the way down because the numbers are increasing, but actually the premium amount is decreasing at just the same rate. So in order to find that out, we're going to have to do some napkin math. Okay, so we mentioned that the premium at 155 is 240. We subtracted the 65 cents from the strike price. Now let's do the same exercise at the $100 level strike price. I'm sure this is a very thinly traded contract. In fact, I was correct. The volume is just one. So there's been one contract at 100 strike price that's been traded. That's magnificent. And 15 contract open interest. I don't know why people would put up money just to have that hanging throughout the day. But anyway, chance of that filling is very slim. So maybe it's some kind of algorithm corporation or market maker. Implied volatility of this option is exactly 0%. I'm sure this is just fun facts, not part of today's discussion, but it's actually not zero. I mean, it's going to be 0.000. Well, actually, it is zero. If you look at the numbers, right, it's the same. But anyway, it doesn't matter. What we want to take a look at now is we're going to calculate the premium value of this option. So the reason I chose 100 is because it's a round number and it's easily subtractable from the current price of the equity, which is 155 and 65 cents. So if we subtract that minus 100, that gives us 55.65, and we compare it to the price of the contract, 55.90. So you can see here that the premium portion of the mark price of the 100 strike September 9th option is only $25. That's it, and that's the mark price. No one's selling or buying at that $55.90, right? It looks like somebody's well, I guess one person, this is the mark, so that means the ask and the bidder are around it somewhere. So 55.80. So you can actually get, I don't know why an implied volatility is zero here. It's not zero. Probably 0.001 or something like that. So it looks like somebody is actually bidding 55.8. So there could be free money potentially here if you sell this option. If you buy the stock and then sell this contract immediately after, you'd be collecting some pennies on the dollar here. In fact, collecting $10. But at what cost, right? You'd be collecting $10. Oh, actually, no. Yeah. $10. But the thing is, like, how much money you have to put in. For Apple, you need, $16,000. $10 per week. It's $40 a month. I mean, it's not horrible, but you could probably get just as much in your savings account. So it's not great. Okay, so running through the trouble to execute this, and then just to get as much money as a money market account, like 1 or 2%, it's not worth it. So there you go. That's that. Now, why do we want to structure all of our option plays around the strike price? Well, that's exactly the reason. Because you're working with some premium. If you try to structure something really far off, then you actually might as well not do it, right? Yeah, the risk is very little. And the good thing about the option wheel is that it gives you stepping stones of risk level tolerance that you want. So like if I want something less risky, I go, let's say I want to, do a call credit spread. So I'll buy a call, let's say over here for 5, and then I'll sell one, for like 2 cents, let's say. And yeah, the risk is very low, and the way that expresses itself is because, I'm only gonna lose like $3 to make this play, but I'm also probably not gonna win anything, right? $3, zero gain, so I'm just gonna lose my money. So that's where the risk, the lowering of the risk is the money amount. Now, if we go down, right? Let's say we want to do we want to do a put credit spread. So we'll buy a put. Well, I guess it's the same. Let's try to do something else. We can try to sell a call here. How about we sell the 100 since we talked about it? So we sell the 100, right? And we'll do credit spread here. And then we buy the higher one. So now we're getting $5, right? Granted, it executes at the mark. We're getting $5. What we're gonna have to put up. Let's see what we're gonna have to put up. Hopefully I don't press. We're gonna have to put up 100 shares of Apple. So anyway, it's really not worth it. Like, the further out you go, the less the premium, the less the opportunity for plays. So that's how it goes. So if you want the fattest premium, work around the strike price. If you want less risk, but no, little chance for payout, you want to do lottery tickets, then go out further down the curve, right? Or further up the wheel or down the wheel. So when you go down on the wheel, the way the risk expresses itself is that the scenario is very unlikely to happen, right? And so you're not rewarded. You're not going to get much reward, right? It's because you're basically on the other side of people who are buying these calls. Like if you go deep into the money, then the chance of the stock dropping all the way down there are very slim. Like let's say you sell a call, that's the 100 strike price call, for example, that we talked about. The chance of Apple dropping by the September 9th below 100 is very, very slim. You're only going to get like $5 for it, right? $10 actually, like we discussed earlier. $10 free dollars, extremely unlikely scenario. So that's where the risk comes in. So you put up a lot of capital, up front. You're going to have to put up your 100 shares of Apple, but you collect very little money, right? So yes, you are going to collect that money, but nothing's going to, but you have to put up a lot of capital. So it's the opportunity cost is pretty big. You could be doing something else with that money. If you were just gonna put in your checkings account, then yes, it's better to do this than checking account. But if a lot of savings accounts are gonna pay you a lot more money than that, right? So it's just no use. There's no point in doing that. You're assuming a tiny bit of risk for a very little reward. And so the people who are buying the calls are right on the other side of it, right? So they're paying a very, very little money for an extremely unlikely scenario. So in either case, up or down the wheel, like the risk is reduced in one way or another, whether through likelihood of the event happening or the amount of money that one needs to expend in order to have a play in there. All right, if you have any questions about it, let me know. I know I kind of went in circles a little bit with the option wheel. No pun intended, kind of. So if you have any questions about it, let me know. I'll do my best to answer it. Maybe I should rehearse these videos or something. Seems like I'm stumbling a lot. But anyway, no redos. It is what it is. Just wanted to record the 191 23,000 down. I'm still pretty optimistic. The reason is Smith and Wesson. I want to show you this play here that I'm doing. So Smith and Wesson is currently 1338. I just needed to stay above 1250 in order to collect a paycheck. I'm gonna collect a pretty big paycheck if that happens. In fact, the value of the paycheck is gonna be over here. It's gonna be $3,800. So what I've done is I've sold some puts at the 12.5 level. I sold a 4 credit spreads, same level, and then I also sold some calls, 12 calls against my current position of 1,200 shares. So, it's a big paycheck. If depending on what happens in a couple of weeks on the 16th, I have to either collect the check and then sell some more calls against the current position, or I'm going to end up having to buy 6,800 shares of Smith and Wesson, putting me at a total of 8,000 shares. So I'm going to be a proud owner of, I've calculated it, 0.02% of a publicly traded company, which was 1 billion market cap at one point. So I'm going to be a pretty big baller, owning a 0.02% of a company. So that's a big bet. Like if you want to calculate what percentage of Apple I own, my 711 shares, it's nowhere near that. It's a very, very tiny percent, but 0.02% is meaningful. So anyway, I thought that was cool. So we'll see what ends up happening. I don't mind owning the company. Smith & Wesson, it's not a financial advice. Obviously, you got to do your own due diligence. But I like it because even though the revenues look like they're going to be declining over the next year or two, I think that the company's made some price hikes and things like that to improve their margins. And they have a pretty sticky business. Obviously, they've been in business for like over 100 years. I don't know how many years, so they're still going to be around. And they're still going to be churning out money, even if they have losing years every once in a while. So I'm not opposed to holding that many shares of Smith & Wesson. I think they bottomed out in 2000, maybe like 18 or something like that, at around the $6 level. So it's only 50% down from, the current price. So I don't think it's that big of a problem, even if I have to hold on the position for a while. And in fact, collecting all that premium against it is going to make it it's going to soften the blows. So it's going to be all right. Okay, so hopefully that play turns out. I also saw some puts on Paramount. Let's see. So Paramount is sitting at 23.07. My puts are at 21. And I've already collected all the money from selling calls against that position. So in fact, the total return is $429 so far. But I'm going to be collecting 5 times 27. So another 100, almost $50 there, $135. So hopefully that happens. But on the actual position, I'm down almost 7,000. So it's small change, small consolation price. Hopefully Paramount goes up to the $29, $30 level again, so I can exit the positions, but I don't mind holding until then. They have a pretty good dividend, solid company, so that'll be good. All right, gotta run. Hopefully you all are making more money than I am. Peace out.